We will now look at clubbing of income. Under these provisions, income of a person can be included in the total income of another person. So first we look at section 64(1)(a), which deals with clubbing of income of a minor child. What does this cover? Income which accrues or arises to the minor child of an individual. Minor child, not major child. Now, where the minor child is suffering from any disability referred under section 80U, right? In the case of 80U disability, then clubbing provision is not attracted, income is not clubbed with the income of the individual. In the case of any other minor child, if income is on account of any manual work done by the minor child, then also clubbing is not done. If income is on account of his skill, talent, knowledge or experience, then also clubbing provision is not attracted. In all other cases, that means in respect of all other incomes, income is clubbed with the income of the individual, that is the parent. Now, where the marriage of his parents does not subsist, then income is clubbed with the income of the parent who maintains the minor child in the previous year. But if the marriage subsists, then income is clubbed with the income of that parent whose total income is greater. And total income is computed how? Excluding the income to be clubbed under this provision. So we determine total income before such clubbing under 64(1)(a), and then income is clubbed in the income of the parent whose such total income is greater. Income in both these cases is clubbed after allowing exemption under section 1032 of rupees 1,500 in respect of each minor child whose income is to be clubbed. Child, it includes a stepchild as well as an adopted child. Exemption of 1,500 under section 1032 is per minor child per year. It is not for each source of income and it is not per month exemption. So as we noted above, income on account of manual work, skill, talent, etc. is not clubbed. So when such income is earned, it is not clubbed. But if such income is invested subsequently, then income arising out of such investment is liable to be clubbed. Okay. So the child wins a prize in a talent competition. That income is not clubbed. But if that prize money is invested in a fixed deposit, then interest on that fixed deposit is liable to be clubbed. We now look at clubbing in case of income of spouse from concern in which individual has substantial interest, section 64(1)(2)(i). This covers a case where income is arising to the spouse of the individual by way of salary, commission, fees or any other form of remuneration, whether in cash or in kind. So income is arising to the spouse from the concern. Now we need to check whether the individual has a substantial interest in the concern. If the individual does not have a substantial interest, then clubbing provision is not attracted. Right? But if the individual has a substantial interest, that means individual has a substantial interest, then clubbing provision is attracted and such income is then clubbed in the hands of the individual. But in such case also, clubbing is still not attracted if the spouse has technical or professional qualifications for the job and the income is solely attributable to the application of a technical or professional knowledge and experience. If that be the case, clubbing is not attracted. If that is not the case, then if the individual has substantial interest in the concern, then the income of the spouse is routed back into the income of the individual by way of the clubbing provision. Now the question is, when is an individual supposed to have substantial interest? Now where the concern is a company, then substantial interest is there when the equity shares of at least 20% are beneficially owned by such person or partly by such person and partly by one or more of his relatives at any time during the previous year. Where the concern is not a company, then 20% is to be seen in respect of the profit share in the concern at any time during the previous year. What is the meaning of relative? Spouse, brother, sister or any lineal ascendant or descendant. You can use the acronym SBSLED for quick learning. What if the income of both the spouses is liable to be clubbed? It can be the case where both the persons, both spouse as well as the individual, are not technically competent for the job and both hold substantial interest in the concern. In that case, clubbing will be attracted in case of both the persons. Then income will be clubbed in the income of the spouse whose total income before applying this provision, that means excluding such income to be clubbed, is greater. Now, when we are supposed to club salary income of the spouse with the income of the individual, then it should be computed under the head salaries, and then we should allow standard deduction under section 16 IA 50,000. If both the spouses have salary income, then both would be entitled to standard deduction, and after providing standard deduction, the income will be liable to be clubbed. Now we look at the provisions regarding clubbing of income from assets transferred to spouse or son's wife. There are three situations. Situation A, 64(1) IV or 64(1)(4). Asset is transferred by the individual to the spouse, right? An asset includes money, and the asset is transferred which is otherwise than for adequate consideration or in connection with an agreement to live apart. So for example, asset is gifted to the spouse and then income arises to the spouse out of such assets transferred, then such income is clubbed with the income of the individual. Situation B covers a similar situation, but in such case, instead of the spouse, assets are transferred to the son's wife, which is otherwise than for adequate consideration. In such case, the income from such asset is clubbed with the income of the individual. In situation C, the income from the asset is routed via, say, any other person or an association of persons. So asset is not directly transferred to the spouse or the son's wife. So asset is transferred to any other person or an association of person by the individual without adequate consideration. Okay, and the income from such assets is then clubbed with the income of the individual, but to what extent? To the extent it is for the benefit, whether immediate or deferred, for the benefit of the spouse or the son's wife, right? So assets have been transferred to any person or association of persons, and clubbing is to the extent the income from such assets is for the benefit of spouse or son's wife. Now, while applying the clubbing provisions, we also need to keep in mind the 56(2)(x) angle. A spouse or son's wife is receiving a sum of money or assets from the individual, 56(2)(x) still won't apply because the asset is being received from a relative, which is specifically exempt in terms of 56(2)(x). But this is what we should nevertheless keep in mind. Now, there will be a situation where the assets are invested by the spouse or son's wife. That means the transferee. In case A and B above. In case A and B above. So assets are received, and assets includes money, and this is invested by the spouse or son's wife. In such case, income to be clubbed in a previous year is computed as follows. First situation is where the assets are invested by the spouse or son's wife, that means transferee, in a business. Then the amount to be clubbed is computed. How? We first determine the income of the transferee from the business in the previous year, and then we apply a ratio to determine the amount to be clubbed. What is the ratio? We figure out the value of such assets that are invested as on what date? As on first day of the previous year, not on any other date, right? And we figure out the total investment in the business by the transferee as on the same day, that is first day of the previous year. We figure out the ratio and we apply this ratio to the income. That brings us to the income to be clubbed. The spouse or son's wife may be a partner in a firm, and the assets may be infused as capital contribution in the firm. In that case, the interest which is receivable from the firm is liable to be clubbed. To what extent? Again, we multiply interest amount with a ratio which is similar to that in the case of business. So we figure out value of such investment as on first day of the previous year, and total investment as capital contribution made by the transferee on the first day of the previous year, and this divided by this becomes the ratio which we apply to the interest, And that brings us to the amount of interest liable to be clubbed. Now, value of assets transferred which are invested as on first day of the previous year is relevant. So even though the assets may be invested during the previous year, but not on first day of that previous year, so clubbing will not apply, because the day which is supposed to be reckoned is the first day of the previous year for the purpose of calculations. Now we need to note that first day of the previous year is mentioned, not 1st April. First day of the previous year is not necessarily 1st April. Recollect the topic on basic concepts. We saw there that if a business is newly set up, then first day of the previous year is the date of setting up of the business, not 1st of April. Clubbing provisions are attracted in case of conversion of self-acquired property into property of HUF, and this is section 64(2). When the member of HUF converts his property into the property of the HUF, the income is clubbed in the hands of the individual. So, in the case of member of a HUF, where he treats his separate property, that means his own property, either he converts it into the property of the HUF, or he throws it into the common stock of the HUF, or he transfers it to the HUF otherwise than for adequate consideration. Then in that case, following is the tax treatment. What happens in respect of income from such property till partition of the HUF? Till partition of the HUF, income from such property is deemed to arise to the individual and not to the HUF, and therefore it is taxable in the hands of the individual, not the HUF. What about income from such converted property after partition? After partition, income that is received by the individual himself is taxable in his own hands. But income which is received by the spouse of the individual is clubbed with the income of the individual. So his own income is taxable in his hands, and his spouse's income share is also taxable in his hands by way of clubbing. Income which is received by other members is taxable in their own hands, not in the hands of the individual. But if the other members includes minor child, then section 64(1)(a) will also come into play, and then income arising to the minor child, right, in this case will be clubbed in the hands of the individual under this provision after giving exemption of 1,500 under section 1032. Now there can be certain transfers which are in the nature of cross transfers. There are two simultaneous or parallel transfers, and both the transfers are intimately interconnected and are parts of the same transaction, but they are shown or they appear in such a way that it can be said that a circuitous method has been adopted as a device to evade section 64 implications, that means tax evasion. In that case, clubbing provisions will apply, and this is by virtue of the Supreme Court decision. So take an example where Mr. A, Master A, who is the minor son of Mr. A, Mr. B, who is the brother of Mr. A, and Mrs. B, who is the spouse of Mr. B. Now Mr. B gives 50,000 for purchase of house to Mrs. B, right? So since Mrs. B is not the spouse or the son's wife of Mr. A, the income from such house will not be clubbed in the income of Mr. A. Now shares worth rupees 50,000 are parallelly gifted by Mr. B to Master A. Now income arising on account of these shares will not be clubbed in the hands of Mr. B because Master A is not the minor son of Mr. B. So effectively Mr. A and Mr. B have indirectly transferred assets to their minor child and spouse without attracting clubbing under section 64(1)(a) or 64(1)(4). Thus in the above example, the cross transfer implications will be triggered, and then income from house property arising to Mrs. B will be clubbed with the income of Mr. B, and dividend income or other income arising to Master A from the shares will be clubbed with the income of Mr. A. Mr. A and Mr. B will be called deemed transferors to Master A and Mrs. B respectively. Now there may be a situation where the amounts involved in cross transfers are not exactly the same, right? So for example, this is 50,000 and this is say 1,50,000. So if the amounts involved vary, then income to be clubbed will be to the extent of the common amount, that is 50,000. That is the lower amount. Income relating to the excess, that is 1 lakh, will be taxable as per the regular provisions in the hands of the transferee, and clubbing provisions won't apply. Now certain principles common to section 64 common to the clubbing provisions. Just as income is to be clubbed, loss is also to be clubbed. Second, clubbing provisions cannot be avoided by saying that the asset transferred has changed its identity. Right? For example, cash is gifted to the spouse and the spouse deposits such cash in fixed deposits of a bank from which interest is received. So cash has been converted to a fixed deposit. Identity has changed, but this will not avoid the clubbing provision. Next, income from accretion of transferred asset is not clubbed. For example, shares are gifted to the spouse, right? Now dividend on shares will be clubbed, but now subsequently bonus shares are issued, which is accretion on account of the shares. So this accretion will not be liable to be clubbed. So if the bonus shares are sold and capital gains arise, then capital gain will not be clubbed. Second generation income is not clubbed. That is income on income, right? For example, if the shares are gifted, then dividend arising on account of that shares is clubbed. Now say dividend income is in turn invested in a fixed deposit. What about interest on fixed deposit? It is second generation income. So that interest on fixed deposit will not be clubbed in the hands of the individual. But we need to note that as far as income of minor child is concerned, this is not relevant because all incomes, whether first generation, second generation, are liable to be clubbed in the hands of the parent under 64(1)(a). Steps to club income. So X is the person whose income is to be clubbed and Y is the person in whose hands it is to be clubbed. So how do we proceed? We figure out the own income of X and Y, which is not liable to be clubbed, which is the normal income. Then we figure out income of X, which is liable to be clubbed in the income of Y. So how we compute it? We compute such income under the relevant head of income after allowing all applicable exemptions and deductions. So that means as per the provisions of the Act. And then we include such income in the income of Y under the relevant head of income. Consequently, we figure out the gross total income of both X and Y, and then we allow deductions under Chapter 6A in the hands of X for payments made by X, in the hands of Y for payments made by Y. This gives us the amount of total income on which we compute tax liability for each of X and Y, and we apply the rate of tax as applicable to each of X and Y independently, rebate 87A independently, and surcharge as applicable to each of X and Y independently. So far, we have looked at the specific provisions of clubbing which apply in specific cases. Now we look at the general provisions of clubbing which apply to all persons. Income arises to any person by virtue of a transfer. There are 4 cases, right? Section 60. There is a transfer of income, but there is no transfer of the related assets. So for example, house property is not transferred, but the income from house property is transferred. In such case, clubbing will be attracted under section 60 and income will be taxable in the hands of the transferor. Next situation is where there is a revocable transfer of assets, section 61. In that case also the income is clubbed, that means it is taxable in the hands of the transferor. So there is a revocable transfer of assets, the transfer can be revoked, right? But there are 2 exceptions. In these 2 exceptions, section 61, that means clubbing does not apply. Number 1, where the transfer is not revocable during the lifetime of the transferee. It may be revocable afterwards, but not during the lifetime. In such case, clubbing doesn't apply. Second, where the transfer is made before 1st April 1961 and which is not revocable for a period of more than 6 years. This is section 61. Third case is where the transfer is deemed to be revocable. It may not be actually be revocable, but it is deemed so, and therefore clubbing applies and income is taxable in the hands of the transferor, section 63. Section 63. And there are 2 situations where the income is clubbed under section 63. Where transfer contains any provision for retransfer of the income to the transferee, it is deemed to be revocable. Or where the transfer gives the transferor a right to reassume the power over the income or the assets, then it is considered to be revocable and clubbing is attracted. Lastly, where there is irrevocable transfer of the assets, there is no issue, right? And therefore there is no clubbing, income is taxable in the hands of the transferee.